Money has always fascinated people. Everyone wants to know how to grow it, protect it, and use it wisely. The stock market has been one of the most powerful tools for building wealth. But at the same time, it has also been one of the most confusing and unpredictable places. Some people believe they can predict the market. They search for patterns in charts. Others believe success comes from carefully studying company reports. Millions of investors look for shortcuts. They want the secret formula that guarantees profits. But again and again, history shows us that markets do not move in straight lines. They move in what Burton Malkiel calls a random walk. The random walk means stock prices move unpredictably. Any new piece of information changes prices instantly. No one can know tomorrow's prices with certainty. This idea may sound discouraging at first, but Malkiel turns it into a powerful lesson. If we cannot predict short-term moves, then the best strategy is to focus on the long term, stay disciplined, and use simple methods that really work. This book is divided into 4 parts. Each part helps us understand markets from a different angle. First, we explore what gives stocks their value and why people sometimes act irrationally. Then we see how professionals play the game, using both logic and psychology. After that, we look at modern tools like behavioral finance and portfolio theory. Finally, we learn a practical step-by-step guide for ordinary investors. The goal of this journey is not to make you a fortune overnight. Instead, it is to show you how to protect and grow your money over a lifetime. Whether you are young and just starting or close to retirement, these lessons can guide you. Part 1. Stocks and their value. When people think about the stock market, the first question that comes to mind is simple. What makes a stock valuable? Is it the company's earnings, its future growth, or is it just the mood of the crowd? For centuries, investors have debated this. Some believe stocks are like solid buildings with firm foundations. They argue that every stock has a true value based on what the company earns and pays out. Others believe prices are built like castles in the air. They rise only because people imagine them to be worth more tomorrow. In this part of the book, Malkiel explores the nature of stock value. He takes us from the logic of mathematics to the madness of crowds. He shows how markets can act rational at times and completely irrational at others. To start, we must understand the 2 classic theories of stock pricing, one built on firm foundations, the other built on air. This takes us to our very first chapter. Firm foundations and castles in the air. Chapter 1. Firm foundations and castles in the air. When we look at a stock, what are we really buying? Some people think of it as a piece of paper with a changing price. Others see it as a share of a real business. This chapter begins with 2 classic theories that try to explain what gives a stock its value. The first is the firm foundation theory. According to this idea, every stock has an intrinsic value. This value is based on the company's assets, its earnings, and the dividends it will pay in the future. Imagine it like the foundation of a building, strong and solid. Even if markets get noisy, this foundation remains. An investor's job, in this view, is to carefully calculate the real worth of a company. If the market price is lower than this value, the stock is a bargain. If the price is higher, the stock is too expensive. The firm foundation theory appeals to logic. It assumes investors are rational people making rational decisions. If everyone studied the numbers, prices would reflect true values. Over time, reality would correct any mistakes. The second is the castles in the air theory. This one takes a very different view. It says that people often buy stocks not because of their fundamental worth, but because they believe someone else will pay more for them later. Investors dream of selling at a higher price, just as one might dream of selling a castle built in the air. This theory does not rely on earnings or dividends. It relies on psychology. The market is seen as a place where crowds chase trends, stories, and excitement. If enough people believe in the dream, prices rise. But when the dream ends, the castle collapses. Malkiel explains that history has shown both forces at work. Sometimes the market behaves rationally. At other times, it looks completely crazy. He gives examples of how investors often switch between these 2 ways of thinking, without even realizing it. Consider a stock like a technology company. A rational investor might calculate its future profits and compare them to the price today. That is the firm foundation method. But another investor might ignore the details and think only about how much excitement surrounds the stock. If everyone is talking about it, they assume prices will go higher. That is the castle in the air method. The problem is that no theory works all the time. The firm foundation approach may be precise, but predicting future earnings is difficult. Economies change. Interest rates change. Companies rise and fall. Small errors in forecasts can lead to big mistakes in valuation. On the other side, the castle in the air approach may look profitable during booms. People make quick money by riding the wave of excitement. But history shows that such waves eventually crash. Those who join late often lose everything. Malkiel warns that both theories carry risks. Blind faith in numbers can mislead, because numbers themselves are uncertain. Blind faith in psychology can mislead, because crowds can turn overnight. Yet understanding these theories is essential. They are the foundation of how investors think. Every market debate, every argument about prices, usually comes back to one of these two views. Is the stock valuable because of solid fundamentals? Or is it valuable only because people believe in the dream? This chapter sets the stage for the rest of the book. Malkiel is not asking us to pick one theory over the other. Instead, he wants us to see how both influence markets. The truth is that investors live in a world shaped by both rational foundations and irrational castles. To ignore either is to misunderstand the market. And so, with these two ideas in mind, we can begin to understand the strange behavior of markets through history. Because when crowds take over, logic often disappears. This leads us directly into the next chapter. The Madness of Crowds. Chapter 2. The Madness of Crowds. Human beings are not always rational. When money is involved, emotions often take control. Greed, fear, and hope can drive people to make decisions that defy logic. History is filled with stories of entire societies losing themselves in financial manias. Burton Malkiel calls this the madness of crowds. One of the earliest and most famous examples is the tulip mania of 17th century Holland. Tulips were rare flowers, admired for their beauty. At first, they were traded like any luxury item. But soon, speculation began. People believed prices would keep rising forever. At the peak of the mania, one tulip bulb could cost more than a house. Families sold property, borrowed money, and risked everything just to buy bulbs. But when confidence collapsed, prices fell overnight. Those who had invested their savings were ruined. This was the first great bubble in financial history. Another dramatic example is the South Sea Bubble in 18th century England. The South Sea Company promised great riches from trade with the Americas. Investors rushed to buy shares, imagining endless profits. Even members of the royal family invested. But the company had little real business. Prices were driven by dreams and false promises. Eventually, the bubble burst. Thousands were left bankrupt. Even great thinkers like Isaac Newton admitted defeat, saying he could calculate the movements of the stars, but not the madness of people. In France at the same time, there was the Mississippi Scheme led by John Law. He promised wealth from colonies in Louisiana. People trusted him, and share prices skyrocketed, but reality could not match the promises. The scheme collapsed, leading to national financial disaster. Malkiel reminds us that such manias are not limited to the distant past. In the 20th century, the Florida real estate boom of the 1920s drew investors who believed land prices would rise forever. Speculators bought property without even seeing it. But when the bubble burst, entire communities were left in ruins. The stock market crash of 1929 is another lesson. In the Roaring Twenties, people believed prosperity had no limits. Stocks doubled and tripled in price. Ordinary citizens borrowed money to buy shares. But in October 1929, the market collapsed. The Great Depression followed, showing how dangerous unchecked speculation can be. What connects all these examples is psychology. Crowds feed on excitement. When people see others getting rich, they fear being left behind. They buy at any price, ignoring risk. The more prices rise, the more confident the crowd becomes. Until suddenly, the dream shatters. Panic replaces greed. Prices collapse much faster than they rose. Malkiel uses these stories to teach us an important lesson. The stock market is not always guided by reason. It is often guided by human emotion. And when millions of people act together, their combined behavior can move markets to extreme levels. For modern investors, this means caution. Just because everyone is buying does not mean it is wise to follow. Crowds can be wrong. In fact, history shows they are often wrong at the most critical moments. At the same time, bubbles and crashes are not just curiosities of history. They continue to appear in new forms. Every generation seems to believe that this time is different. But human nature has not changed. The cycle of greed and fear repeats itself again and again. This chapter prepares us for the decades ahead. To understand the stock market from the 1960s to the 1990s, we must see how past patterns of crowd behavior shaped investor thinking. Markets may look modern and advanced, but deep down, they are still driven by the same human impulses. And so we move forward to the next stage of our journey. A closer look at stock valuation in the modern age. The period from the 60s to the 90s. Chapter 3. Stock valuation from the 60s to the 90s. The 60s were a period of optimism and rapid growth in the stock market. Investors believed the economy would continue to expand forever. New industries like electronics, aerospace, and consumer goods attracted attention. Growth stocks, companies expected to increase profits faster than others, became the favorites of the market. Prices rose steadily, and many investors thought the upward trend would never end. During the 70s, the mood changed. Inflation rose sharply, oil prices spiked, and economies around the world faced uncertainty. Investors became cautious. Many previously high-flying stocks declined. Valuation techniques became more important as people tried to measure whether stocks were overvalued or undervalued. Dividend-paying companies gained more attention because they offered some stability in turbulent times. The 80s brought a new era of recovery. Interest rates fell and economic growth returned. Corporate mergers and leveraged buyouts became common. Companies like Coca-Cola, IBM, and General Electric led the way. Investors regained confidence. Valuations once again became a topic of discussion, but now the market was more sophisticated. Analysts focused on earnings growth, price-to-earnings ratios, and other measures to guide investment decisions. Then came the 90s, marked by the rise of technology and the internet. Suddenly, a small startup with an innovative idea could attract millions in investment. People were less interested in profits and more excited by potential. Companies with little revenue or even losses were valued in the billions. The market was electrified by the promise of a new digital world. Valuation models struggled to keep up. Traditional metrics like earnings and dividends seemed irrelevant. Malkiel shows that through all these decades, markets behaved in cycles of optimism and fear. Investors tried to apply formulas and rules, but human emotions often disrupted the calculations. Bull markets encouraged risk-taking and speculation. Bear markets forced caution and careful analysis. Yet, despite these swings, long-term growth was undeniable for those who remained invested. A key lesson from this period is the difficulty of predicting stock prices. Even the most careful analysis can fail in the face of changing economic conditions or sudden shifts in investor sentiment. A stock that seems undervalued one year can become overvalued the next. Markets are influenced by many unpredictable factors: interest rates, political events, technological breakthroughs, and the ever-present psychology of the crowd. Malkiel also points out that during these decades, investment fashions changed. Growth investing was popular in the 60s, value investing in the 70s, and speculation in the 90s. Each wave had its enthusiasts and critics. Investors often followed trends, buying what was currently praised and avoiding what was out of favor. History shows that following the crowd can be dangerous. At the same time, this period demonstrates that long-term strategies still work. Despite booms and busts, patient investors who stayed diversified and focused on fundamentals generally succeeded. The random walk of the market does not mean chaos. It means that short-term predictions are unreliable, but disciplined investment pays off over decades. As the century closed, a new phenomenon appeared: the internet bubble. Companies with no profits yet sky-high valuations captured the public imagination. This was a reminder that history often repeats itself, and that crowd psychology continues to play a central role in market behavior. With this understanding of past stock valuations, we are ready to examine one of the largest financial manias in modern history. The late 90s internet bubble, a story of excitement, speculation, and eventual collapse. Chapter 4: The biggest bubble of all. Surfing on the internet. The late 1990s brought one of the most dramatic examples of speculation in history: the internet bubble. Technology promised to change the world, and investors were eager to get a share of this new digital revolution. The excitement was everywhere. Companies with innovative ideas attracted huge amounts of money, even if they had no profits, no products, and sometimes no clear plan. Investors were caught up in the idea that this time was different. The internet would create endless opportunities, and the old rules of valuation no longer seemed to apply. Stock prices soared. A tiny startup could see its value skyrocket in days. Ordinary people, not just professional investors, were buying shares, hoping to ride the wave of instant wealth. Malkiel explains that this frenzy followed patterns seen in previous bubbles. Human emotions, greed, fear of missing out, and optimism drove prices far above any reasonable measure of intrinsic value. Investors believed that profits were guaranteed and that prices would never fall. Analysts praised companies for their potential rather than actual results. The castles in the air theory was in full effect. During the bubble, conventional measures like earnings, dividends, and assets were ignored. Companies were judged by website clicks, user numbers, and brand recognition. Venture capital poured in, and initial public offerings, IPOs, became major events. Early investors often made enormous profits, further fueling the frenzy. But as always with bubbles, the early winners were few, and the latecomers suffered most. By the year 2000, the bubble began to burst. Many internet companies could not deliver profits. Their business models were unproven. Investors lost faith. Stock prices collapsed, wiping out trillions of dollars in value. Companies vanished, fortunes disappeared, and the market reeled from the shock. Malkiel uses this example to show how history repeats itself. Even with modern technology and advanced markets, human behavior remains consistent. Crowds can become irrational. Markets can detach from reality. Speculation can drive prices to extremes before crashing. The internet bubble also illustrates a broader lesson about risk. Chasing short-term excitement and ignoring fundamentals can be disastrous. It reinforces the idea that understanding value is more important than following hype. While some investors made fortunes, most who ignored traditional valuation principles suffered losses. At the same time, the bubble did not destroy the long-term potential of investing. Companies that had strong fundamentals survived and prospered. Those who focused on real value rather than speculation benefited over time. Malkiel emphasizes that disciplined investing and a clear understanding of value remain the best tools for long-term success. This chapter sets the stage for a deeper exploration of the logic behind valuing stocks. After seeing how speculation can drive prices to extremes, it is essential to revisit the firm foundation theory. How should investors think about a stock's true worth? How do dividends, earnings, and growth influence value? These questions lead directly into the next chapter. Chapter 5: The Firm Foundation Theory of Stock Prices. After exploring bubbles and crowd behavior, it is time to return to the idea of rational valuation. The firm foundation theory focuses on the intrinsic value of a stock. According to this theory, a stock is worth what it is expected to earn in the future. Its value comes from tangible fundamentals such as earnings, dividends, and growth potential. Malkiel explains that the value of a stock can be thought of like a bond. A bond pays interest, and its price depends on the future interest payments. Similarly, a stock's value depends on the expected future cash flows it provides to the investor. If a company earns more and pays regular dividends, the stock is more valuable. If earnings decline, the stock is less valuable. One of the most widely used methods is the dividend discount model. It calculates the present value of all expected future dividends. The idea is simple. Money received today is more valuable than the same amount received in the future. By discounting future payments to today's terms, investors can estimate what a stock is truly worth. Malkiel also discusses growth stocks. Some companies reinvest earnings instead of paying dividends. For these firms, expected growth becomes a crucial factor. If a company can grow earnings at a steady rate, the future value of the stock rises. Investors must estimate growth rates carefully, because overestimating can lead to paying too much, while underestimating may cause missed opportunities. The firm foundation theory assumes rational investors. They make decisions based on careful calculations and solid information. They do not follow fads or emotions. When prices deviate from intrinsic value, rational investors buy undervalued stocks and sell overvalued ones. Over time, the market should reflect true value. However, Malkiel cautions that even this theory is not perfect. Predicting the future is never easy. Economic conditions change. Companies face competition, regulation, and unexpected events. Interest rates fluctuate. Even small errors in estimation can lead to wrong valuations. Yet, despite its limits, the firm foundation approach provides a logical framework for investing. Another important point is that the theory helps investors resist the temptation of speculation. Understanding intrinsic value encourages long-term thinking. Instead of chasing short-term trends or fads, investors focus on companies with solid earnings and realistic growth. This discipline often leads to more consistent results over time. By combining careful analysis with patience, the firm foundation theory gives investors a map in the sometimes chaotic world of stocks. It reminds us that while crowds can create bubbles and crashes, rational evaluation of value remains essential. As we close part 1, Malkiel transitions to the next stage of investing. Now that we understand what drives stock value and how markets can behave irrationally, it is time to see how professionals play the biggest game in town. How do analysts, fund managers, and traders try to beat the market? What strategies do they use, and how successful are they? Part 2. How the pros play the biggest game in town. In Part 1, we learned what gives stocks their value, and how crowd psychology can drive prices to extremes. Now we turn to the professionals. Analysts, fund managers, and traders all try to beat the market. They study charts, financial statements, and economic trends. Some rely on technical signals. Others focus on company fundamentals. This part explores the strategies used by the pros. Are they really able to predict the market? Can their tools and experience give them an edge over ordinary investors? Malkiel examines both the methods and the limits of professional investing. We begin with technical and fundamental analysis, the two dominant approaches in the investment world. These methods reveal how professionals interpret price movements and company data. Chapter 6. Technical and Fundamental Analysis. Professional investors use two main approaches to understand and predict stock movements. The first is technical analysis. It focuses on studying past price patterns, trading volumes, and charts. The idea is that history repeats itself, and by identifying patterns, traders can forecast future price movements. Technical analysts use tools like moving averages, trend lines, and oscillators. They watch for signals of buying or selling, hoping to gain an advantage over the market. The second approach is fundamental analysis. Instead of looking at charts, fundamental analysts examine a company's financial health. They study balance sheets, income statements, cash flows, and management quality. They evaluate how much a company earns, its growth potential, and how it compares to competitors. The goal is to determine the stock's intrinsic value. If the stock trades below this value, it is considered a buying opportunity. Malkiel explains that technical analysis appeals to traders who want short-term gains. It is popular in volatile markets where price swings are frequent. Charts can show trends, reversals, and momentum shifts. Patterns such as head and shoulders, double tops, and triangles are believed to indicate future movements. Traders try to profit by buying low and selling high based on these signals. Fundamental analysis, on the other hand, is often used by long-term investors. It requires patience and research. Analysts look beyond daily market noise to understand the real strength of a business. They ask questions like, is the company growing sustainably? Does it have strong management? Is it in a stable industry? Can it survive economic downturns? By answering these questions, investors attempt to buy undervalued stocks and hold them until their true value is recognized by the market. Malkiel notes that both methods have strengths and weaknesses. Technical analysis can identify short-term trends, but it is often unreliable over the long term. Patterns may appear in charts even if there is no real reason behind them. Fundamental analysis is logical and rational, but it depends on accurate estimates of future earnings, which are inherently uncertain. Unexpected events, market sentiment, and economic shocks can undermine even the best calculations. He also emphasizes the role of market efficiency. Even if an analyst identifies a good investment, the market often adjusts quickly to new information. Prices reflect expectations, news, and investor sentiment almost instantly. This makes consistently outperforming the market extremely difficult. Malkiel concludes that while both technical and fundamental analysis are widely used, neither guarantees success. Technical analysis may offer some insights for short-term traders, but long-term wealth creation is more likely through careful fundamental analysis combined with patience, diversification, and disciplined investing. This chapter sets the stage for a deeper examination of technical analysis and its relationship to the random walk theory. Can past prices really predict future movements, or is the market fundamentally unpredictable? Chapter 7. Technical Analysis and the Random Walk Theory. Technical analysis is one of the most popular tools among traders. By studying past price patterns, trends, and volume, analysts try to forecast future movements. Charts are filled with lines, shapes, and signals meant to reveal the market's next move. Patterns such as head and shoulders, triangles, or double tops are believed to indicate whether prices will rise or fall. But Malkiel introduces a critical challenge to this approach: the random walk theory. This theory suggests that stock prices move in a completely random way. Every new piece of information, good or bad, instantly affects prices. Because new information is unpredictable, price movements cannot be consistently forecasted using past patterns alone. In other words, tomorrow's price is largely independent of yesterday's chart. Malkiel explains that if the random walk theory is correct, then technical analysis loses its predictive power. Patterns that appear meaningful are often just coincidences. A trend may seem to form, only to disappear unexpectedly. Traders who rely solely on past data may be misled, believing they can predict the market when, in reality, the market is responding to unpredictable news. He also points out that technical analysis can work in the very short term, especially when emotions drive the market. In some cases, traders can profit from momentum, but the results are inconsistent and risky. Over time, as more people act on the same signals, any advantage diminishes. The market quickly incorporates collective behavior, leaving little room for consistent profits. Malkiel gives examples of studies where portfolios based purely on technical signals performed no better than random selection. Even professionals who spend hours analyzing charts do not reliably outperform a simple buy and hold strategy. The market's apparent patterns are often illusions, a reflection of randomness rather than skill. Despite these limitations, technical analysis is still widely used. Traders enjoy the challenge, the strategy, and the psychology involved. Charts provide a sense of control in a market that is otherwise unpredictable. But Malkiel warns that reliance on these patterns as a primary strategy is risky. It can create the illusion of mastery while ignoring fundamental value. The random walk theory has a broader implication. It challenges the idea that anyone can consistently beat the market through short-term predictions. If prices follow a random path, the best long-term strategy is to focus on diversification, patience, and rational investing, rather than chasing patterns or trying to time the market. This chapter prepares the ground for the next discussion: fundamental analysis and the efficient market hypothesis. If technical signals cannot reliably predict prices, can studying a company's financials give an edge? Or are markets already efficient, making it nearly impossible for anyone to consistently outperform? Chapter 8. How good is fundamental analysis? The efficient market hypothesis. Fundamental analysis aims to determine a stock's intrinsic value by studying a company's earnings, assets, dividends, and management quality. Investors hope that by identifying undervalued stocks, they can buy low and sell high. But Malkiel introduces a key question. Can fundamental analysis consistently beat the market? This is where the efficient market hypothesis, EMH, comes in. EMH states that stock prices already reflect all available information. Every earnings report, news story, or financial forecast is quickly incorporated into a stock's price. As a result, no investor can consistently achieve higher returns than the market average by analyzing public information. Malkiel explains that the hypothesis has three forms. The weak form suggests that past price and volume information is already reflected in prices, making technical analysis ineffective. The semi-strong form includes all publicly available information, like earnings reports and economic data, implying that fundamental analysis cannot consistently outperform the market. The strong form goes further, suggesting even insider information is reflected in prices. While the strong form is debated, the weak and semi-strong forms are widely supported by research. Studies have shown that most professional fund managers do not consistently beat the market. Some years they outperform, others they underperform. Over long periods, the average performance of active managers is similar to that of passive investors who simply track market indices. This supports the EMH idea that markets are remarkably efficient. Malkiel emphasizes that this does not make fundamental analysis useless. It is still valuable for understanding businesses and making informed investment decisions. However, trying to use it to consistently outperform the market is unlikely. Investors should focus on strategies that work over the long term rather than trying to time short-term movements or predict winners. One implication of EMH is the power of index investing. By owning a broad portfolio of stocks that mirrors the market, investors capture average returns without the risk and cost of frequent trading. Low-cost index funds and exchange-traded funds allow investors to invest efficiently while avoiding high fees and mistakes that often reduce returns. Malkiel also warns about overconfidence. Many investors believe they can identify undervalued stocks or predict market trends better than others. Yet research repeatedly shows that luck and randomness often play a bigger role than skill. Accepting market efficiency encourages discipline, patience, and focus on long-term growth. Finally, this chapter sets the stage for modern portfolio theory, which builds on the principles of diversification and risk management. If neither technical nor fundamental analysis guarantee success, how can investors optimize their returns while managing risk? The answer lies in combining assets intelligently to reduce volatility and increase expected reward. Chapter 9. A New Walking Shoe. Modern Portfolio Theory. If the efficient market hypothesis shows that consistently beating the market is nearly impossible, how can investors improve their chances of success? The answer comes from modern portfolio theory, MPT. Developed by Harry Markowitz, MPT is like giving investors a new walking shoe, tools to navigate the unpredictable terrain of the market more effectively. At its core, modern portfolio theory is about diversification. Instead of putting all money into one stock or one industry, investors spread their investments across different assets. The idea is simple. When some investments perform poorly, others may perform well, reducing overall risk. Diversification does not guarantee profits, but it smooths out ups and downs, helping investors reach long-term goals more safely. MPT also introduces the concept of the efficient frontier. This is a set of portfolios that offers the highest expected return for a given level of risk. Portfolios below the efficient frontier are inefficient, providing lower returns for the same risk. By combining assets intelligently, investors can move closer to the efficient frontier and optimize their risk-reward balance. Malkiel explains the relationship between risk and reward. Traditionally, higher returns are associated with higher risk. Modern portfolio theory quantifies risk through the variance or standard deviation of returns. By carefully selecting assets with different correlations, investors can reduce overall portfolio risk while maintaining expected returns. For example, stocks and bonds often move in opposite directions. Combining them can stabilize performance. Another key insight is that MPT encourages long-term thinking. Short-term fluctuations are unpredictable, but a well-diversified portfolio tends to perform more steadily over decades. It discourages speculative bets on individual stocks and emphasizes the importance of planning, discipline, and patience. Malkiel highlights that modern portfolio theory is not perfect. It relies on historical data, assumptions about correlations, and estimates of expected returns. Unexpected events can still cause losses. However, compared to concentrated investments, MPT provides a systematic and rational framework to manage risk. MPT also lays the foundation for asset allocation. How much should be invested in stocks, bonds, or other assets? How should international investments be included? These decisions are guided by risk tolerance, investment horizon, and financial goals. By structuring a portfolio strategically, investors can pursue higher returns while controlling exposure to risk. In practical terms, modern portfolio theory revolutionized investing. It led to the creation of index funds, mutual funds, and diversified ETFs. Ordinary investors could now build portfolios that balance risk and reward without relying on constant market timing or stock picking. This chapter prepares us for the next discussion: how investors can reap rewards by increasing risk. Malkiel explores the trade-off between risk and potential return, and how understanding this balance can guide smarter investment choices. Chapter 10: Reaping Reward by Increasing Risk. Modern portfolio theory teaches that risk and reward are linked. The greater the risk, the higher the potential reward, but also the greater the potential loss. Understanding this relationship is key to making smart investment decisions. Malkiel explains how investors can use risk strategically to improve returns without taking unnecessary chances. One way to manage risk is through asset allocation. Stocks are generally riskier than bonds, but they offer higher long-term returns. Bonds are safer, but their growth potential is lower. By balancing investments across different asset types, investors can increase expected returns while controlling the overall risk of their portfolio. Another important concept is risk tolerance. Every investor has a different ability to withstand losses. Younger investors with decades until retirement can afford to take more risks because they have time to recover from downturns. Older investors, nearing retirement, may prefer safer investments. Malkiel emphasizes that aligning your portfolio with your risk tolerance is more important than chasing the highest possible return. Diversification remains central. Combining assets with low or negative correlation reduces volatility. For example, when stocks fall, bonds may rise or stay stable. By spreading investments across industries, countries, and asset types, investors can reduce the impact of any single loss on their overall portfolio. Malkiel also discusses speculative risk. This is the risk taken when chasing individual stocks, new technologies, or hot sectors. While these investments can produce big gains, they are unpredictable and often resemble gambling more than rational investing. Investors who rely heavily on speculation may experience dramatic short-term gains, but they also face the potential for catastrophic losses. The chapter emphasizes long-term planning. Short-term risk is unavoidable, but disciplined, diversified, and patient investing allows one to benefit from the market's overall upward trend. Over decades, the market historically has rewarded investors who understand risk, avoid speculation, and stay committed to their strategies. Malkiel uses examples of different portfolios to show how increasing risk can increase expected returns, but only if done thoughtfully. Simply taking high risks without strategy is unlikely to succeed. By combining diversification, careful asset allocation, and attention to personal risk tolerance, investors can reap rewards while minimizing unnecessary losses. Finally, this chapter connects naturally to the next part of the book: the new investment technology. Behavioral finance, modern valuation tools, and lessons from market history build on these concepts. Understanding risk and reward prepares investors to use these tools wisely. Part 3. The new investment technology. In Part 2, we explored how professionals play the market, using technical and fundamental analysis, portfolio theory, and risk management. Now, in Part 3, we move into the innovations that have transformed investing. This part focuses on behavioral finance, new ways to value stocks, and the lessons of market history. We will see how psychology influences decisions, how modern tools can improve analysis, and how investors can learn from patterns over time. These ideas provide practical guidance for both seasoned investors and beginners. By combining modern techniques with long-term principles, one can navigate markets more intelligently. Chapter 11. Behavioral Finance. Investors are not always rational. Emotions, cognitive biases, and social pressures often shape decisions more than careful analysis. This is the foundation of behavioral finance, a field that studies how human psychology affects financial behavior and market outcomes. Malkiel explains that investors often make predictable mistakes. One common bias is overconfidence. People tend to believe they can beat the market or pick winners, even when statistics show otherwise. Overconfident investors trade too frequently, underestimate risks, and sometimes ignore important information. This can lead to lower long-term returns. Another common bias is loss aversion. Investors feel the pain of losses more strongly than the pleasure of gains. This leads to holding losing stocks too long, hoping they will recover, or selling winning stocks too early to lock in gains. Emotional decision-making can conflict with rational strategies, reducing overall portfolio performance. Malkiel also highlights the herding effect. People often follow the crowd rather than making independent judgments. This explains why bubbles and panics happen repeatedly in markets. When everyone buys a hot stock, prices soar. When panic sets in, everyone sells, even if fundamentals remain strong. Mental accounting is another bias. Investors treat money differently depending on its source or intended use. For example, they may take excessive risks with a bonus, but play it safe with retirement savings. This inconsistent approach can distort decision-making and portfolio strategy. Behavioral finance also examines anchoring. Investors fixate on past prices or arbitrary reference points. For example, they may believe a stock is cheap because it previously traded higher, ignoring current fundamentals. Anchoring often prevents objective assessment and leads to poor investment choices. Despite these tendencies, understanding behavioral biases offers a practical advantage. By recognizing common psychological pitfalls, investors can design strategies to avoid them. Diversification, disciplined asset allocation, and rules-based investing help mitigate the impact of emotions on decisions. Malkiel emphasizes that markets are a mix of rational analysis and psychological behavior. Even if investors try to act logically, human emotion still creates volatility and opportunities. For example, mispricing caused by overreaction or panic can provide buying opportunities for patient investors who understand value. Behavioral finance also complements modern portfolio theory. While MPT focuses on numbers, diversification, and risk, behavioral finance reminds investors that humans are imperfect decision-makers. A successful strategy integrates both: a rational framework guided by discipline and awareness of psychological traps. This chapter prepares the way for new ways to value stocks. If psychology can distort prices, modern techniques can help assess whether a stock is overvalued or undervalued. By combining behavioral insights with advanced valuation methods, investors can make more informed choices. Chapter 12. New ways to value stocks. Traditional methods of valuing stocks, like dividends or earnings multiples, sometimes fail to capture the full picture. The late 20th century brought new techniques to help investors better understand a company's true worth. These methods combine financial analysis with modern insights, allowing for more informed decision-making. Malkiel explains the concept of discounted cash flow, DCF. Instead of focusing only on current earnings or dividends, DCF calculates the present value of all expected future cash flows. By estimating how much money a company will generate over time and discounting it to today's terms, investors can evaluate whether a stock is fairly priced. This method is powerful, but requires careful assumptions about growth rates, discount rates, and business risks. Another technique is earnings-based valuation. Analysts look at price-to-earnings ratios, comparing a company's stock price to its annual earnings. By benchmarking against peers or historical averages, investors can identify whether a stock is overvalued or undervalued. Malkiel emphasizes that while PE ratios are simple, they must be interpreted in context. A high PE may indicate strong growth potential, but it can also signal excessive speculation. Malkiel also highlights adjusted accounting metrics. Companies may manipulate accounting rules, so investors examine cash flows, operating earnings, and other adjusted figures to get a clearer view of performance. This helps avoid misleading conclusions based on superficial earnings reports. Valuation is not only about numbers. Malkiel reminds us to consider qualitative factors. Management quality, competitive advantages, market position, and innovation potential all affect long-term value. Even the most sophisticated models cannot replace judgment about the sustainability of a business. Behavioral finance also influences valuation. Investor sentiment can push prices above or below intrinsic value. By combining modern valuation methods with an understanding of psychology, investors can identify opportunities where the market has mispriced a stock. Buying undervalued companies during periods of pessimism or avoiding overhyped stocks during mania can enhance returns. Malkiel provides practical guidance for ordinary investors. Even without complex models, basic principles apply. Focus on long-term growth, understand cash flows, and remain skeptical of short-term hype. Avoiding speculation and maintaining a diversified portfolio are crucial. Finally, these new valuation techniques connect directly to lessons from history. Markets may be unpredictable in the short term, but over decades, stocks tend to reflect their intrinsic value. Studying past patterns, crashes, and booms can guide better investment decisions. This leads naturally to Chapter 13, the lessons of market history. By understanding past successes and failures, investors can prepare for future opportunities while avoiding common mistakes. Chapter 13, the lessons of market history. History provides valuable guidance for investors. By studying past market cycles, booms, and crashes, we can understand patterns of human behavior and how they influence stock prices. Malkiel emphasizes that although markets are unpredictable in the short term, long-term trends show growth for patient investors. One key lesson is that market bubbles repeat. From the tulip mania to the internet bubble, speculation drives prices far above intrinsic value. Human psychology, greed, optimism, and herding creates these bubbles. When reality catches up, the market corrects sharply, causing losses for those who bought at inflated prices. Recognizing the warning signs of bubbles helps investors avoid catastrophic mistakes. Another lesson is the importance of diversification. Investors who concentrated on a single stock, sector, or region often suffered heavy losses during crashes. Spreading investments across industries, countries, and asset types reduces the impact of market downturns and smooths long-term returns. Malkiel also highlights the value of long-term investing. Stock prices fluctuate daily, but over decades, markets historically rise. Investors who remain committed during downturns tend to benefit from recovery and growth. Attempting to time the market, on the other hand, is risky and rarely successful. Patience and discipline are more reliable than prediction. History shows that dividends matter. Companies that consistently pay dividends provide stability and income during volatile periods. Reinvesting dividends can significantly enhance long-term returns. Stocks that grow dividends steadily tend to be solid, reliable investments, even in uncertain times. Market history also teaches the danger of speculation and hype. Hot sectors or new technologies attract attention and investment, sometimes inflating prices beyond reasonable expectations. Many investors chase quick profits during these periods, only to face losses when enthusiasm fades. Learning from past manias, like the railroad boom, the Great Depression, or the dot-com bubble, helps avoid repeating mistakes. Malkiel points out the importance of valuation. Companies that are priced reasonably relative to earnings, cash flow, and growth potential provide better long-term returns than those bought at excessive premiums. While short-term performance can be erratic, over decades, valuation matters. Finally, history emphasizes market resilience. Despite crashes, wars, recessions, and panics, global stock markets have historically grown over long periods. This reinforces the principle that disciplined investing, informed by historical knowledge, patience, and rational analysis, offers the best chance for wealth accumulation. These lessons set the stage for practical guidance. Investors need not only theory, but also strategies to implement them effectively. This leads directly into Chapter 14, a fitness manual for random walkers and other investors. Chapter 14, a fitness manual for random walkers and other investors. Investing is like maintaining physical fitness. Just as a healthy body requires consistent exercise, a healthy portfolio requires consistent care and disciplined strategies. Malkiel uses this chapter to provide practical guidance for both new and experienced investors, emphasizing simplicity, patience, and rational decision-making. The first principle is diversification. Investors should spread money across stocks, bonds, and other assets to reduce risk. By avoiding concentration in a single stock or sector, the portfolio can withstand market volatility while capturing long-term growth. Diversification is the financial equivalent of a balanced diet. It may not produce instant excitement, but it supports steady, reliable results. Next is long-term investing. Malkiel stresses that markets fluctuate in the short term, but they generally rise over decades. Investors who stay committed to a well-structured portfolio tend to benefit from compound growth. Trying to time the market or chase short-term gains often leads to unnecessary losses. Patience, therefore, is a key skill in the investor's toolkit. Asset allocation is another critical factor. Determining the right mix of stocks, bonds, and other investments depends on personal goals, risk tolerance, and investment horizon. Younger investors may favor higher-risk stocks for growth, while older investors may shift toward bonds and safer assets. Malkiel emphasizes that allocation is more important than stock picking for long-term success. Malkiel also highlights the dangers of speculation. Chasing hot tips or trendy stocks is tempting but risky. Emotional investing often leads to buying at peaks and selling at troughs. Instead, investors should focus on fundamentals, valuation, and consistent strategies. Rules-based approaches, such as investing in index funds, help remove emotion from decisions. Another important point is cost efficiency. High fees, commissions, and frequent trading reduce returns over time. Low-cost funds and passive strategies allow investors to capture market returns without losing a significant portion to expenses. Malkiel shows that minimizing costs is a simple but powerful way to improve long-term performance. Behavioral discipline is also essential. Investors should avoid overreacting to market news, fear, or greed. Recognizing cognitive biases, such as overconfidence or loss aversion, helps maintain rational decision-making. Keeping a clear, structured plan allows one to stay on course during periods of volatility. Finally, Malkiel provides a practical checklist. Diversify, maintain asset allocation, invest for the long term, minimize costs, avoid speculation, and stay disciplined. By following these principles, investors can build a resilient portfolio capable of withstanding market turbulence while achieving growth. This chapter bridges into Part 4, where Malkiel provides a step-by-step guide for applying these principles in everyday investing. From life cycle strategies to practical tips, the next section equips investors to take control of their financial journey. Part 4, a practical guide for random walkers and other investors. In Part 3, we explored modern tools, behavioral insights, and lessons from market history. Now, Part 4 brings all these ideas together into a practical roadmap. This section is about actionable guidance. It shows how to build and manage a portfolio, make investment decisions based on personal goals, and apply principles like diversification, long-term thinking, and discipline. It emphasizes simplicity, low costs, and consistency. Investors will learn how to structure portfolios for different life stages, avoid common mistakes, and follow a system that maximizes returns while controlling risk. Chapter 15, A fitness manual for random walkers and other investors. The Malkiel Money Guide. This chapter brings together all the lessons of investing into a practical guide for everyday investors. Malkiel likens financial fitness to physical fitness. Consistent effort, discipline, and a structured plan lead to long-term success. The first principle is simplicity. Investors should avoid overly complex strategies, frequent trading, or chasing hot stocks. Instead, focus on a balanced, diversified portfolio that reflects your goals and risk tolerance. Simple, consistent actions often outperform complicated schemes over time. Diversification remains key. Spread investments across stocks, bonds, and other asset types. Within stocks, diversify across industries and regions. This reduces the risk that any single investment can derail your portfolio. Malkiel emphasizes that diversification is the most powerful tool for reducing risk without sacrificing long-term returns. Low-cost investing is another core principle. High fees, commissions, and fund expenses erode returns over decades. Malkiel recommends using low-cost index funds and exchange-traded funds to capture market growth efficiently. Minimizing costs is one of the easiest ways to improve net returns without increasing risk. Malkiel also emphasizes long-term perspective. Stock markets fluctuate daily, but historically they have risen over decades. Patience and discipline are more valuable than timing trades or attempting to predict short-term movements. Avoiding panic during downturns and resisting the urge to chase short-term gains is critical. Behavioral awareness is essential. Investors must recognize their own biases, such as overconfidence, loss aversion, and herd behavior. Developing a rules-based approach, such as automatic investments or preset allocations, helps reduce emotional decision-making. Another practical tip is asset allocation. The right mix of stocks, bonds, and other assets depends on age, goals, and risk tolerance. Younger investors can afford more stocks for growth, while those nearing retirement may favor bonds to preserve capital. Regularly reviewing and rebalancing the portfolio ensures it remains aligned with your objectives. Malkiel also discusses emergency planning and liquidity. Investors should maintain sufficient cash or liquid assets for unexpected expenses. This prevents the need to sell investments at unfavorable times and supports long-term strategy. Finally, Malkiel provides a step-by-step action plan. Diversify broadly, keep costs low, invest for the long term, allocate assets based on personal goals, remain disciplined, and avoid speculation. By following these principles, even ordinary investors can achieve financial fitness and long-term success. This chapter connects to Chapter 16, which explores life cycle investing. How should investment strategies change at different stages of life? Understanding this allows investors to tailor their portfolios and risk exposure over time. Chapter 16. A Life Cycle Guide to Investing. Investing is not one size fits all. Your goals, risk tolerance, and time horizon change as you move through life. Malkiel's Life Cycle Guide helps investors structure portfolios according to different stages, from early adulthood to retirement. For young investors, the priority is growth. With decades until retirement, they can afford to take more risk. Stocks should form the largest part of the portfolio because they offer higher long-term returns despite short-term volatility. Bonds and cash play a smaller role but provide some stability. Young investors should focus on low-cost, diversified funds and invest consistently over time. In midlife, goals expand. Investors may face expenses like buying a home, children's education, or business investments. Risk tolerance may decrease slightly, and portfolios should shift gradually toward a balanced mix of stocks and bonds. Diversification remains critical, and maintaining a long-term perspective helps manage market fluctuations. Regular rebalancing ensures the portfolio aligns with changing priorities. As investors approach retirement, preservation of capital becomes central. The focus shifts towards safer investments like bonds and cash equivalents. Stocks remain important to maintain purchasing power against inflation, but their proportion decreases. Income-generating investments, such as dividend-paying stocks or bonds, help support living expenses. Malkiel stresses that time horizon is the key determinant of risk tolerance. The longer the investment period, the more volatility can be tolerated. Short-term goals require safer, more liquid assets, while long-term goals allow for higher exposure to growth-oriented investments. Behavioral discipline is vital across all stages. Young investors must avoid panic during downturns. Midlife investors should resist chasing market fads. Near retirees should not abandon diversification out of fear. Following a rules-based plan reduces emotional errors. Malkiel also emphasizes tax efficiency and cost control throughout the life cycle. Investing in tax-advantaged accounts, minimizing transaction costs, and avoiding high-fee funds all contribute to long-term wealth accumulation. Even small differences compound significantly over decades. Finally, he recommends periodic portfolio review and adjustment. Life events, market changes, and personal goals evolve over time. Regular reviews ensure that asset allocation, risk exposure, and investment choices remain aligned with objectives. This chapter provides the framework for taking concrete steps in portfolio management. It naturally leads to Chapter 17, which outlines 3 giant steps down Wall Street, practical, actionable strategies to implement all these principles efficiently. Chapter 17, 3 Giant Steps Down Wall Street. Malkiel concludes his guide with 3 giant steps every investor can take to succeed in the market. These steps are practical, straightforward, and grounded in the lessons of previous chapters. They focus on strategy, discipline, and simplicity. The first step is invest in broad-based, low-cost index funds. Trying to pick individual stocks or time the market is risky and rarely successful. Index funds provide diversification, low fees, and exposure to the overall market. By owning a slice of many companies, investors capture long-term growth while reducing the risk of major losses. This aligns perfectly with modern portfolio theory and the efficient market hypothesis. The second step is maintain proper asset allocation. Allocate investments according to your goals, risk tolerance, and time horizon. Younger investors may favor stocks for growth, while older investors shift toward bonds and safer assets. Rebalance periodically to keep the portfolio aligned with your objectives. This discipline prevents overexposure to risk and helps manage emotions during market volatility. The third step is invest regularly and stay the course. Consistent investing, such as monthly contributions to retirement accounts or mutual funds, takes advantage of dollar-cost averaging. By investing steadily regardless of market ups and downs, investors buy more shares when prices are low and fewer when prices are high. Over time, this strategy reduces risk and harnesses the power of compounding. Malkiel emphasizes the importance of discipline and patience. Markets fluctuate unpredictably, and even the best strategies require time to produce results. Avoiding speculative behavior, resisting the temptation to chase trends, and focusing on long-term goals are key to investment success. He also notes the value of keeping costs low. High fees, commissions, and taxes reduce returns significantly over decades. Simple, low-cost investment vehicles, combined with disciplined saving and allocation, maximize the net benefit of market participation. These 3 steps summarize the book's practical wisdom. They combine insights from technical and fundamental analysis, behavioral finance, modern portfolio theory, and historical lessons. Investors who follow these principles, diversification, cost efficiency, asset allocation, regular investing, and patience, are most likely to achieve financial success. Malkiel ends with a reminder. Investing is not a gamble, it is a long-term journey. Understanding risk, avoiding emotion-driven mistakes, and adhering to proven strategies will serve investors far better than attempting to beat the market or chase short-term trends. By applying these 3 giant steps, anyone, from beginners to experienced investors, can walk down Wall Street with confidence, discipline, and the potential to achieve financial growth over time. This concludes Part 4 and the main content of A Random Walk Down Wall Street. The principles of diversification, patience, low-cost investing, and behavioral awareness create a roadmap for lifelong financial fitness. If you enjoyed this summary and want more practical, easy-to-follow insights on investing and financial wisdom, make sure to subscribe. Hit the button and join us for more guides, summaries, and strategies to help you grow your wealth and make smarter financial decisions. Stay informed, stay disciplined, and let's walk down Wall Street together.